this insidious thing called inflation that you don't notice year by year can destroy your purchasing power and what you have.
Should you be betting everything you've got on one big payday? And the answer may change how you as a business owner want to operate your business.
And so they felt like they were on the cutting edge. Things changed pretty soon. They were no longer the leading technology in that space, and their company went from what they thought was a lot of money to worth nothing almost overnight.
Far too many entrepreneurs and business owners assume that there is going to be a pot of gold at the end of the rainbow, and that whenever they throw their hands up, someone's going to want to buy this business and pay a boatload of money for it. And the exact inverse of that is true.
We knew after talking to private equity that they would destroy our model.
Jim, welcome back here. We're a few months into January. How's the new year started for you?
It's good. I'm happy. I'm enjoying the year so far. I'm excited for what we've got planned. How about you? What's going on with you?
It's good. I've got actually what's called a Misogi, which is some hard challenges that you're looking to do. I was listening to a podcast with Jesse Itzler, who's married to Sarah Blakely.
Yes.
And he's got the big ass calendar, and I bought the big ass calendar, and it's actually been really cool because it forces you to kind of map out as best you can the entire year. The premise being, if you aren't intentional about mapping stuff out and trying to book things like mini adventures, big challenges, then like life just kind of comes by and you're not intentional and you default to just more work or more of the same. So it's been cool to kind of post that, or we have that in our laundry room and all the sticky notes. So it's been fun. Yeah.
Well, it's the old analogy, right? If you don't put the big things into the calendar, all the little things that don't matter are going to just take over.
Yeah, 100%. Yeah. So it's been good. I'm still on track, making progress towards my big Misogi goals. So although we're a few months into the new year, it's always important because a lot of New Year's resolutions fail.
That is true. A large majority.
Well, I'm excited to jump in here. We're going to start by talking about a topic that destroys a lot of different things. It's inflation. So since 2000, hospital services are up 275%, college tuition 196%, childcare, I feel this acutely, 185%, TV costs down 98%, so that's good news there. But things that don't matter got cheaper. The things that define your quality of life, they're crushing wealth faster than most entrepreneurs realize. So I wanted just to start us off, and we're going to put a chart up here that just shows a nice visual, and nice may be the wrong word, but just shows the increase in the cost of some of these core things over the last 25 years. And the first thing is, there's a few things that stuck out to me in here, but I'm curious, as you look at this chart, as we're showing it on the screen, what are some of the takeaways from you?
First of all, and there's a lot of pressure on this, is college worth it at the current price? Because the prices have gone so much since when I went to college. You have to start asking, is the value there? And I don't know. I don't have kids, so I don't have to worry about it. That's a big one. And then also healthcare, just the cost of everything like hospital services. Just it's extraordinary how much it's gone and up, and how much it's really making it difficult for a lot of Americans.
Yeah. I mean, and if you look back at in 2000, the medical care now is up 129%, childcare up 185%. And there's some troubling demographic trends here in the United States. And I think part of the attribution is due to the cost. And when childcare is very, very expensive, up 185% since 2000. And very few people's income has grown at that level or is up 185% or 200% since 2000. So definitely some troubling trends here. But on the good news, cell phone services down 43%.
Yeah.
It's interesting. I feel like my cell phone bill goes up every single month.
Yeah, there's good. It's interesting about just inflation in general. And I was just reminding myself of a quote from one of the Ernest Hemingway books, where one character is talking to the other character, and he says, "How'd you go broke?" And the other character says, "Well, first, I only went broke in two ways. First, gradually, and then suddenly," which is, by the way, how everyone goes broke. But I often think about people and their wealth, and the way people go broke in their wealth is either suddenly, like they invest in a bunch of dumb, risky things, or gradually. They invest so conservatively that gradually over time, this insidious thing called inflation that you don't notice year by year can destroy your purchasing power and what you have.
Yeah. And I think an example here is, let's just say that your burn rate as an entrepreneur is $500,000 a year of after-tax income. If we were to look at the same cost of living for that $500,000 in 2000, 25 years ago, it would have cost $260,000. So think of that as you think of what is your consumption going to look like in another 25 years. Now, granted, we've had some hot bouts of inflation coming out of COVID.
Yep.
There's a lot of reasons for that. And
Yep.
hopefully we don't have those 9% inflation reads anymore. But it's crazy to think about those entrepreneurs that are spending $500,000 a year of after-tax money, and another 25 years just for that same quality of life. It's going to cost $1 million a year just to run that.
Yeah, you got to plan for that. And that's why, investing in assets that appreciate faster than inflation is just a critical, basic, fundamental thing that you need to do for building wealth.
Yep. And then, like you said, if you're sitting on cash, you're accepting that you are deteriorating your purchasing power with the value of that $5 million in cash going down to $2.6 million over 25 years. So it's cash. Being sitting in cash is taking an intentional position. I think sometimes entrepreneurs think like, oh, I'll just park some money in cash and I'll figure it out later. And that can work if there's ever that figuring out later piece. Whereas sometimes it's just cash is cash, and they like sit on cash, and then 1 year turns into 3 years, turns into 5 years. Then all of a sudden it's like, okay, by us not being intentional about getting this deployed somewhere, we're being intentional by letting it sit on our balance sheet and erode our wealth.
Yeah, you hear some people say cash is trash, other people say cash is king, and I always say it depends. And the key with cash is you need to know what that cash is for. And sometimes, like you said, I know entrepreneurs will be sitting on $1 to $5 million of cash, and I'll say, what's that cash for? They go, I don't know. When I see an opportunity. Well, how will you know when you see the opportunity? And they really haven't thought it through. If you have $1 million of cash and you say, I know it's not a good investment, it just feels good, it's a soft pillow to sleep on at night. If you have enough other assets and resources, no problem. That's what that cash is for. It's your soft pillow to sleep on. But if you don't know what your cash is for, that's a problem. If you're sitting on cash because you're a real estate expert and you know when there is a moment where you can jump in and buy something and you have your criteria and your process, that can be a good use of cash. But too often entrepreneurs don't even know why they have the cash. And you need to know, why do you have the cash? What is the purpose for it? And then you can be smart with your cash.
Yep. I totally agree. And based off the current readings, right, we're in that 2.5% to 3% inflation reading. I know the Fed tries to target at 2%. We've been obviously running ahead of that 2% target, but the economy is also growing, I think, a little bit better than expected. So the good news is that inflation has come back down to a more reasonable level. I think if it can sit in that 2 to 3% range, that would probably be success for most people. I think we all just have learned a big lesson of, I think, people who were around and saw the big inflation readings in the 70s and even the early 80s remember that, not too surprised. But I know for my generation, what happened after COVID was the first bout of inflation that I've really seen in a meaningful way. And I can definitely see how that shapes perceptions and how you can see it drastically erode your purchasing power. And it also hurts those generally on the lower income even worse, because groceries and eggs going up by 8%, 10% a year hurts those people on a fixed budget a lot more than us entrepreneurs that continue to create and grow more wealth.
Yeah, it's funny you mentioned that, because in my household growing up, inflation was so high at the time in the country that it was a big conversation in my household. And inflation was this huge, terrible thing that we had to get under control. I didn't quite understand it. But years later, when I was working with younger entrepreneurs, it was hard for them to understand when inflation was at 2%, that actually over time, 2% can be meaningful. And you could have higher inflation, which no one actually anticipated until the massive overreaction by the government on COVID, which was a big reason for the inflation.
Yeah. So inflation is silently eroding wealth. And one question that I want to transition us into is if you're an entrepreneur, should you be betting everything you've got on one big payday? And the answer may change how you as a business owner want to operate your business. So I was listening to a podcast. It's called MoneyWise, giving them credit here. And of all businesses that are created, only 0.02% achieve a meaningful liquidity event. So It's crazy. And I'll break that number, because in 2024, there were 5.2 million businesses that were created. And we got a chart that we're going to throw up here that shows business creation in the United States. You'll see a nice big spike from 2020, 21, and it's really kind of maintained a lot higher. So the American entrepreneurial spirit is back and alive after COVID. But if there are about 5 million businesses that are created per year, and then based off of the Census Bureau data, there was about 14,000 M&A deals in 2024. So that being the numerator, the denominator being all those businesses, that means only about 0.02% of businesses potentially have a kind of a liquidity event there. So it is a very small probability of having that big payoff. So then the question begs is, should you as a business owner be optimizing and putting all your eggs in the basket to have this liquidity event? Or should we be harvesting along the way or optimizing for cash flow or some combination of the three?
Yeah, it's interesting. I bet if we looked at a survey of the percentage of entrepreneurs that actually think they're going to have a successful exit, a meaningful exit, I bet it's a lot higher than 1%. It's probably half. I bet it's a huge percentage, because I know we deal with more elite entrepreneurs with bigger companies, but I think if we talk to our clients, probably 80 or 90% of them are expecting a meaningful exit. And that could be true, but it might not be true.
Yep.
It's like they say, right? You need to plan for all contingencies.
Yep, exactly. And then we've got a chart here we'll put up here that just shows the survival rate, which just says in year 1, about 80% of businesses that are created survive or are still around. But by the time you get to year 10, only about 30% of businesses that have been created are still around. So that being said, there's really three.
By the way, we're in year 27.
We're in year 27.
That's pretty good.
Yes.
We broke through that.
Only 15 to 20%, according to this data, go beyond 20 years. So then another visual that we'll put up here is 3 different paths. So as an entrepreneur, as a business owner, I think it's good to be intentional about what is my plan to unlock, if I'm going to unlock the enterprise value or the value of the business that's sitting underneath me. And I think that's important to be intentional, because there's one path, which is, hey, I'm just going to, let's say on one extreme, reinvest all of my proceeds, hyper grow, and just build this thing to sell. The pro being that if I have that big liquidity event, then I'm going to have an awesome personal financial transaction, but there's a lot of risk if I'm not harvesting along the way. The opposite end of the spectrum, which you'll see in the visual here, is going to be the cash flow machine. This is going to be someone who's just optimizing their business and all of their decisions for just cash flow. Really, this would be more like a lifestyle business that's really built around you as the operator. And then the middle ground we'll call harvest along the way. This is someone who's intentionally reinvesting, actively looking to grow the enterprise value, but is also taking some excess chips or excess profit off the table and building meaningful wealth and treasure, so to speak, on their personal balance sheet. So 3 different and distinct paths here. So before we break these down, Jim, which of these 3 paths, if you're talking to an entrepreneur, do you think is the path?
Obviously, it depends on the entrepreneur, but I would say the path that I would recommend for most entrepreneurs is path B, harvest along the way. So even if you're growing a great business, even if your goal is to exit, harvest along the way. Because if it doesn't work out, if it doesn't happen, you have something to fall back on. And I know you and I have seen entrepreneurs that we have coached to do that had enough in reserve to where a business took a wrong turn and failed, and they were able to support their family and start a new business that then paid off. Because often entrepreneurs that make it don't make it in the first business. Sometimes it's the second or third. But if you don't have any resources, you end up taking a job somewhere and then your game is over. So I like path B for most entrepreneurs. I would say a smaller number would be the build to sell, where you don't even care about profits. It used to be a couple of years ago, there were more M&A deals where there were multiples of revenue in certain industries. And now we're back to more, they want to see profits. I mean, with some exceptions, but usually they want to see profits. So profits allow you to do things. It allows your company to continue. And by taking that profit and investing that outside of the business, you create a war chest for your future. And eventually you have enough money where the business can fail and you're still fine.
Yep. I agree. I think that path B is kind of a healthy middle ground, but I think it really depends on the risk tolerance. And then, like you said, the season of life or the phase that the entrepreneur is in, because I do see quite a few entrepreneurs who maybe have harvested enough off of previous businesses or had a full cycle liquidity event. If they start a new business, they may be focused on that first path of just, hey, I'm taken care of. Let me just see what I can build if I just went all in on trying to build an amazing business and have like that liquidity event.
I love that. I love like they've already become financially secure. They don't need any more money. And now they're like, hey, let's blow this thing up and see if we can create a huge exit. I really like that, because then they're okay either way.
Yep. All right. Well, let's break these down a little bit more in depth. So the first path is build to sell. So here, really, it's going to be all about maximizing the business value. Every dollar redeployed, invested back in there, and personal liquidity is really only going to kind of come at a sale. So here, one of the pros is that this is the best way of getting wealthy. And, you're going to make most likely way more money at the sale of your business because you're selling at a multiple of your annual profits than just through harvesting, the after-tax income every single year. And it's just like, that's, I think, truth. Now, there's also the most risk here. You're going to have the concentration risk here. You're going to have the fact that only 0.02% of businesses based off of this data actually sell. And then it sometimes takes a long time to have that liquidity event. So are you going to be able to stay in the game? If you're not harvesting and building your wealth and you're not having those dopamine hits or that gratification along the way, sometimes it's hard to stay glued in if you're not getting the positive reinforcement of seeing your balance sheet or your net worth grow. But from oftentimes we'll see this really in Silicon Valley, venture backed, right? They're looking for 20% plus internal rate of returns as investors. And so oftentimes, really Silicon Valley, this is the playbook. And I think that's the easiest analogy of like the build and optimize for sale.
Yeah, I was just talking to someone the other day who had fallen into the build to sell, and it was in the space of VR. And if you think about it, there was this time where Apple and Google, they were buying up VR companies for huge multiples to get the technology and everything else. And so they felt like they were on the cutting edge. Things changed pretty soon. They were no longer the leading technology in that space. And their company went from what they thought was a lot of money to worth nothing almost overnight. And that can happen when you're trying to build to sell. On the other hand, you can get very rich. There are some people that got very rich over this concentration. I'd say you got to know what you're doing. And you also have to not only do the smart things, but also plan for the exit. And I think things like a C Corp, if you want to get the 1202 treatment that was increased under the One Big Beautiful Bill, that can be great. If you plan to take on investors, you want to really think in that A level of what does the exit look like and how to prepare for it today. Are you going to try to go public? Are you going to take on investors? What's the right structure for all those outcomes? And that has to be paramount if you're not thinking about harvesting or cash flowing.
Yep. And just to break down that 1202 concept, if you are a C corporation and you hold your C Corp stock for 5 years, at the sale, you get $15 million or 10 times your investment or your basis tax-free. And then you can stack this with different irrevocable trusts. If you hold it for 4 years, you get 75% of that tax-free. Hold it for 3 years, 50% of that tax-free. So just putting some frameworks around that. And to your point, we oftentimes recommend and see a lot of our clients who either have side businesses or are building a business intentionally for that liquidity event structured as a C corporation because of those favorable tax treatments under Section 1202.
Yeah, that makes sense, because if you were building to take money out of the business, a C Corp's probably not your number one option because of the double taxation. You get taxed at the C level and then you get taxed at the personal level. So there may be a better entity structure if you're looking to pull money out of the business over time.
Yep. Awesome. So let's go through option B. This is going to be kind of a middle ground here of harvesting along the way. You and I both are biased towards this. This is what we're actively doing within our business.
Yep.
And so the idea is that we first are going to feed the business because that is the golden goose that is laying the eggs. So you need to first make sure you're redeploying enough capital back into the business where you hopefully are getting the highest rate of return compared to anything else that's available to you from an investment perspective. But then as there's excess free cash flow or profits, you're taking that, you're distributing it, and you're building up your personal balance sheet. So that way you're socking away some squirrels or some nuts, I should say, like a squirrel for winter there. So this helps with diversification along the way. But the idea, or that one of the downsides here, is that if you could have hypothetically grown the enterprise value even faster by redeploying more capital here, maybe you're not going to sell at the same multiple or the same exit price as if you went all in on just optimizing for the sale. So there's some pros and cons there. And also from a tax perspective, a little less tax efficient, because if you're taking profits out, generally depending on your structure, if it's passed through, you're paying ordinary income and they're going to reinvest those after-tax proceeds. Whereas if you're redeploying all of the cash in your C corporation, you're only paying 21% on your profits before you redeploy it back in the business.
Very true. Yeah. As you said, I'm biased toward that just because anything could happen before an exit. And if that's what you're hoping for and that's what you're betting your entire financial future on, that can be a problem. But yeah, I like to pull money out as you go along.
Yep. All right. Then the last one would just be optimizing for cash flow. This would be more of the traditional lifestyle business. Think of a high producing attorney or consultant that maybe has some support staff that help optimize or fine tune the professional or the service or whatever it is. But there's really no enterprise value there, right? There's nothing transferable. There's no way to have a liquidity event because it's more of you've got a glorified job, which is a business. And then the system, the team, and the infrastructure is just to support you, and a buyer's not going to want to buy a job. So this is really optimized for a lifestyle. And generally here, the definition of success is probably how much are you making per hour worked, because you care about not only the numerator, which is how much you're making, but also the denominator. How much time are you working? Because that's where I think how you would define success here.
I remember there was a guy that I knew in town who was a financial advisor, and he had built up a book of business of just mutual funds with trails. So this is probably 20 years ago. And there were people who wanted to buy his business, but the more he looked at it, the more he figured out, you know what, why don't I just create a lifestyle business out of this business? And what he did was he fired all his staff. He went to all of his clients and he said, hey, if you want to move your money away, and they were all in mutual funds and paying him 0.25% trail every year. And he said, well, if you want to leave, you can leave, do whatever you want, but I don't have any staff. So when you need me, it's going to take a few more days to get any paperwork done. I take 2 weeks off a month and go to San Diego. So I'm only working 2 weeks a month, and we can meet at the coffee shop, or you can come to my house, or I can come to your house, but I don't have an office. And so some clients left, but a lot of clients stayed. And what he told me was he's only working 2 weeks a month, and he was making more money than when he was running his business. So that's kind of the lifestyle business we're talking about. He just cut it all down, made it unsellable, but didn't care. And he was probably about 65 or 70. I don't know how long he did that, but he could have done that for another 10 or 15 years and really enjoyed it. So that's a lifestyle business. That's what we're talking about, something like that.
I think the biggest thing here is being intentional, because he was very intentional. So that is a very clear definition of success. Whereas I think oftentimes entrepreneurs are not intentional. They're just kind of inertia. It's just taking them in a certain direction and they don't really know. And I think that's the biggest thing here is take a second to zoom out and be intentional about what the exit plan is going to look like, or what type of business are you trying to build, and then optimize around that instead of letting just life drive you down a certain, trail that maybe you don't want to go down.
That's very true. And entrepreneurs often are running a business without thinking about doing the basics like books and records, because sometimes entrepreneurs are running businesses, making a lot of money. They're not thinking of selling. And then all of a sudden someone comes forward and says, hey, private equity steps up and says, hey, we'd like to buy your business. Let's have a conversation. And then they get down the path and PE beats them up for having terrible books and records, because they thought, well, I never thought I was going to sell this business. So you should always be, preparing like you are going to sell your business, even if you're thinking of more of a siphoning money off over time, or even a lifestyle business. Someone always might want to buy your business. So you should be running the books and records, the P&Ls, as if you're going to, and that'll help you run a better business anyway, even if it's a lifestyle cash flow business.
Yep. All right. So 5 questions that every entrepreneur should ask himself. First thing here is, what is your number? And so I think this is good that how exactly would you define financial freedom? And I think making sure you know what that number is very important, because I think that you can look at life through a different lens of abundance once you have that number. And maybe you want to intentionally pivot your business one way or another once you've hit that number. You'll make different decisions. So I think that's very important. The second thing is, what percentage of your net?
Can I say one thing on that, on that question? When I did my MBA, and I did my MBA in 1995, so, a few years ago. And one of my classmates was a guy who worked for Intel, and he called me up at our 10-year anniversary from our MBA, and he said, hey, let's have lunch. I went out to lunch with him. I said, how's it going? He goes, I love what I'm doing. I go, you love what you're doing at Intel? He goes, yeah. I go, that's interesting. Why do you love it so much? And he said, well, because I don't have to work there if I don't want to. And I said, why is that? Well, if you remember, Intel stock went on a tear. In the 80s and 90s, it was like crushing. And in those days, you could have all your money in a 401k within the company stock. So he, like everyone else, or a lot of people had, all of his 401k was Intel stock. And he said it was the year 2000. And all these guys were talking about how much their 401ks were. And he said he looked at his one day and he did the math and he goes, wow, that's enough. I could retire today with that much. So he said he didn't think anything about it. He wasn't following the stock. He just said, I'm just going to sell because now I have enough. So he sold his Intel stock, and then Intel crashed 2000 to 2002 and all these things. So then he was in his mind, he was retired. So he told me that when the job's difficult or a manager gives him a hard time, he just smiles because he's like, I could pack up my stuff and leave. I don't need you guys at all. And that helped him enjoy his job more. So just like that scenario, if you know your number, it gives you something that you go, when I get there, I have a certain peace of mind, a certain comfort. And that's what it did for him.
Yep. Great example there. Second question, what percentage of your net worth is tied up in your business? And before you can answer that question, you have to answer realistically, what is the value of my business? Because I need to understand the value of my business to then define it as a percentage of my net worth. The idea being here that if a disproportionate amount of your net worth is tied up in the value of your business, you may want to explore taking chips off the table and doing a hybrid harvesting strategy, because you're overly leveraged on trying to have that liquidity event, which just means you're taking on more risk.
Yeah, it's funny that as an entrepreneur, I know that it's easy to have overconfidence about your company. And I feel there's no way our company can fail. And I felt that for a long time. But the reality is big companies fail. NVIDIA almost failed a few times in their whole journey. So to think that our company has no risk is not reality. And yet entrepreneurs, they feel because they have control, because they built the company, they think their company is invincible, and then they get so concentrated. It's funny that some of those entrepreneurs also say they don't trust the stock market. I don't trust the stock market, and yet they've got 100% of their net worth in their own little teeny company. And I mean, a company that's doing $1 billion a year is a small company in this country, and all of our entrepreneurs are doing a lot less than that. So keeping that in mind, that yes, your business, you have control and you're confident in your business, but make sure that you're also realizing that there's risk to be concentrated that way in your business.
Yep. All right. Third question. What's the honest assessment of an exit probability? Like we talked about, there's statistic after statistic that even if you want to go to market, most businesses that go to market don't sell. And so it's just the harsh reality that most businesses, especially if we're talking about 5 million businesses being created a year, goes back to that statistic, that 0.02% transact per year. So
I think it's good to get an outside opinion on that too, and not another entrepreneur friend of yours, because every entrepreneur thinks their business is sellable and worth a ton of money. And whether that's an M&A expert that or a valuation specialist or something, get an idea from someone outside, like, is this company worth anything? How much do you think it's worth? Would it sell? And if not, what could I do to make it more appealing or more sellable?
Yep. All right. Fourth question. What's the time horizon? Because as we talked about, there's some tax strategies around 1202 stock and QSBS that if your time horizon to sell is 5 years, or maybe you're thinking, hey, I have 5 years left, maybe you want to pivot your strategy from harvesting to going all in on a sale before you run out of steam, or vice versa, right? Maybe you were all reinvesting and you're like, oh, okay, I don't know if the probability of me selling is as high as I thought it was. Maybe I'll pivot. Maybe I'll do a restructuring to figure out if there's more optimal ways to find a better middle ground. So I think time horizon, and again, being intentional on mapping out what your life looks like and what you want it to look like is very important here.
Yeah, definitely. I know in our situation, I never imagined an exit, for most of the 27 years. And it was about 13 years ago that someone at a private bank called me up and wanted to have a serious conversation and said, hey, I like what you guys are doing. We'd be interested in buying your company. And that was the first moment when I thought, maybe this could be something that I would sell. And at the time I thought, well, I have no interest in selling it because we have so much more to do to grow it. But that was the first time I thought, maybe I should be thinking about a potential exit. So, it's good to think about your time horizon, which I never really thought about. And that way you can plan and make smarter decisions.
All right, last question here. What does your family need in terms and regardless of your business outcome? I think this is very important, because if we separate the business versus the personal side, if that business completely disappeared, what is the situation? What's the standing with your family and your finances?
Yeah, and this is a moving target. And a lot of times entrepreneurs, they confuse what their family needs and what their family wants. And they almost think, if I can't have my Lamborghini or my Ferrari, my life's over. And that's not reality. So I think it's an important thing to not only have an idea, but also have a reality check. Like, what would I be comfortable with? What matters most? And, taking a vacation with the kids, that matters a lot. How you do it, that matters a lot. But whether you have the coolest toys that you can show off to your friends, that doesn't really matter for your happiness or for anything else. And I've seen entrepreneurs that over time, they keep expanding these numbers to where it becomes almost unsustainable unless they have this enormous exit. And so making sure that they're honest and they're in touch with reality about how can they live their best life. And it's not that you got the coolest car in the parking lot. There's a lot more to it than that. But I see that creep. I don't know if you can relate to that with some of the clients.
Yeah, I 100% agree. And we were talking before we went live here about, like, if you're doing $5 million of EBITDA, let's say after tax, you're pulling in $3 million a year of a pass-through business. You sell at 6x times the 5 million is 30 million, maybe 25 million, 24 million after tax. okay, well, like if that was just all, that's 8 years of runway, based off of what you're spending. That doesn't sound like a whole lot. And so that's where I think you need to, like you said, obviously that money would grow, but when your burn rate and your consumption is so high, you have to get a very big exit multiple in order to create enough wealth to sustain that lifestyle.
Yeah. And that's where I like, if you're going to do stuff with your money that is not not something that you want to be prepared to have a part of your life forever, I'd rather see you do things that are not like locking into long-term payments. Like you buy a house that's too expensive or too big, and then it's hard to go backwards. Or you get in a car payment that you don't really need. If you take a vacation, you spend too much money, you don't have to do that again. But some of these things people get locked into, and then it becomes a status thing where they feel like their personal worth is tied to that car or that house or something like that. And then it becomes problematic if they have to go the other direction. And there's nothing that feels as good as positive cash flow and having more money coming in than you're spending. And if there's a blip in the business, you don't panic and go, maybe everything that I care about, that I want, is going to crumble before my eyes.
Yep, spot on. All right, so we laid out the 3 different paths. Now let's talk through what happens when you actually sell. There is a good Coutts research on 121 entrepreneurs who've been through exits. And it really goes through, hey, once the money lands, that's when the real challenges begin. So an entrepreneur who actually went through a liquidity event sent me this because this was a good, useful guide for him. So teeing this conversation up, Jim, 84% of entrepreneurs end up satisfied with life after exit, according to this research report, which is actually a lot higher.
Yeah, it's higher than I would have thought.
Some other data suggests. But what nobody will tell the entrepreneurs is that 40% who didn't plan regret it. And it takes 2 to 4 years to find the new identity. So it takes a lot longer for the entrepreneurs post-liquidity event to really kind of get into a groove than where they think what it's going to be. So just putting some of that, some numbers here. I'm going to put this chart up on the screen, but 57% of entrepreneurs, again, from this case or white paper here, who were selling, expected to really kind of settle into the new role and be happy within 1 year, less than 1 year, but only 40% achieved that. 5% expected it to take 2 to 4 years for them to really settle into kind of the new normal and be happiness. But in reality, there's 20% in that bucket. And then 0% of entrepreneurs who sold their business thought it would take 4 or more years for them to feel satisfied, where in reality, 7% of entrepreneurs who sell takes them 4 years before they feel satisfied with the decision that they made.
Yeah, that is really fascinating. And I'm sure it's true from my experience. That's what I've seen a lot. It's that kind of thing where the way you envision it seems like your problem is getting through the exit. Your problem is not after the exit, because you think after the exit, I have no problems. And then it turns out you've got to figure out, what am I going to do with my life? And I've heard that from several entrepreneurs. I can think of one in particular, sold his business. Guess what? His friends were working, his friends were running businesses. And all of a sudden he's like, well, I can't golf 7 days a week and there's no one to go hang out with because everyone's busy doing stuff and I have nothing to do. Well, that means that you've got to reinvent yourself. You got to think of something that you can do that you enjoy, that's meaningful. How are you going to spend your time? Because no one's just going to sit in a rocking chair and watch TV all day. And if you do, you'll be miserable and you'll die young.
Yep. And we got post-exit challenges. We're going to put up a visual right here. What you specifically went into was example number 5, or challenge number 5, which is finding purpose is more challenging than expected. And so, right, with the quote here, when you emerge from building a business, the things that motivate you will be quite different. And so one of the recommendations from this survey and from the publishers of this was budget 10% of your proceeds to figure it out, which is interesting. So whether that's, you think it's starting new businesses, following new hobbies, traveling more to see the grandkids, or whatever else it may be, carve a specific part of your budget out to just figuring it out. And then like having the autonomy to move flows and budget around to that avail. So that's challenge number 5. We start at the very top here of this visual. Number 1, you'll make more mistakes than you expect. This, I think, is overconfidence bias. Said another way, you have a successful liquidity event. The press release goes out. All of the bankers and investment advisors are calling you, wanting to manage your money, and your friends are asking you to invest in their business. So you feel like you're walking on water here. But in reality, maybe those skills that you created to have that successful liquidity event were very useful and applicable in the domain and where you were applying them, but doesn't necessarily mean it transfers into other facets of life or other businesses or ventures. Yeah,
I've seen this a lot, where an entrepreneur who's never had any money because all the money was in the business, they have a huge liquidity event, and all of a sudden they're an expert in private equity and venture capital and startups and all these in cryptocurrency. all these areas that all of a sudden they think they're experts. And other people treat them like they're experts because they had this big exit. So all of a sudden they have all this social proof and this social support that they know all these things. And I used to say that, and I could say it right now, that the biggest risk to an entrepreneur is startup and 3 years post-exit as far as their wealth building. Because I've seen so much money flush down the drain through bad investments and bad ideas. Now, if you've been siphoning money off over the years and you've learned and you have a team that's helping you invest and you have a good handle at it, you can take that exit and you can flow it right into your allocation. But if you haven't been doing that, you have to think, maybe you're not as smart as you think you are. And the challenge is, as entrepreneurs, we have to say yes all the time. Like, yes, let's try that. Yes, we can do that. And when you become an investor after an exit, you have to say no a lot. And so that's a new habit for entrepreneurs. And I also say you have to change from investing in possibilities to probabilities. The entrepreneur starts a business because he or she thinks this thing has a possibility. No one believes I can do it, but I believe I can do it. So they turn a possibility into this huge exit. So then they start looking for other things like that. Instead, they need to flip their perspective and start to look for probabilities. The things that will probably 10 years from now appreciate, the things that are probably going to make you money, not the things that possibly could make you money. That's a hard shift for entrepreneurs. Say no a lot and look for things that have high probabilities, not that have possibilities.
Yep, well said. And I think that dovetails exactly into challenge number 2. Your attitude to risk changes dramatically. And because to your point, you are the risk taker, you're the maverick when you're building your business. Post-exit, you've got this wad of money. You now want to make sure you preserve that and that you can achieve your goals and you're not forced to expose everything. So that was a good job dovetailing right into my second challenge.
Yeah.
Third challenge here, walking away harder than you think. So 60% say it's harder than anticipated to leave the business entirely. As one entrepreneur was quoted, that never really goes away. Many always come back to business. So the passion that drove that success most likely isn't just going to disappear. So it's all about where are you instead going to be pointing that laser?
Yeah, and you know me well enough to know that's a challenge for me. I'm not a golfer. I don't have a lot of hobbies. I love the business. I love the people in our business. And for me to not be involved in the business, it would be hard for me to get my head wrapped around that. I do know that it's a time for entrepreneurs to find different things. And I remember I was on a flight sitting next to this guy in first class, and he had a business exit. And I was talking to him, and he said the first few years afterwards, he didn't know what to do. He had all this free time, and he really got depressed and bummed out. And he felt like I was this big, important person. Now nobody knows who I am. And then he started thinking about, well, what do I want to do? What should I, and as he thought about it, here was the really interesting thing. He said, I came up with some stuff that I'd never tried, but I thought I might like that. And I tried it. I said, give me an example. He said, ice skating. He said, I always thought ice skating looked interesting. Never learned to ice skate. So I thought, I'm going to learn to ice skate. And this guy was like late 50s. So I said, how'd that go? He said he was horrible for a long time, and then he got good enough, and then he joined a hockey league, and he said he's like in the worst of the hockey leagues, like the most terrible players, but he said he has the best time. He has all these relationships with these guys he plays with, and I said, wow, that's pretty incredible. He goes, now I'm going to learn to play guitar. So, that's the other thing too, is you don't have to think so linearly like nobody knows who I am. Do something interesting, go serve in a charity or volunteer or learn a new skill like ice skating or playing guitar. And that was a key to his actually having success after the success of the exit.
Yeah, and him getting fulfilled based off of what is going to fulfill him making a decision, an independent decision, and not essentially measuring himself to external people or achievements, but really finding that internal peace and that internal happiness. That's the cool part about that story.
Yeah, none of his friends said, hey, you should try to learn to ice skate. You've never ice skated. Try to join a hockey league. It was just what he came up with. And so some of that can be great to do some soul searching, find out some ideas of experiences that you can have in your life.
Yep. Okay. Last challenge 4 here, since we kind of reverse order. It takes longer than you think. I think this is very important for entrepreneurs, just to reset expectations of give yourself grace. It could take 2, 3, 4 years before you settle into a group, just like the guy that you were sitting next to. It took him a few years to kind of figure it out. I think oftentimes entrepreneurs want to immediately have the game plan set up of I'm going to go golfing on these days and then travel and do this. And then after 3 months, it's like, all right, I need to figure something else out. And that's where just giving yourself grace and setting expectations and going on a sabbatical is very smart and intentional. So then that way you can figure out, hey, where are my passions actually lying?
Yeah, it's a good exercise is to create some white space in your calendar. Even if you're running your business, you need some white space to think and to plan. And whether it's pre or post exit, if you don't have any white space in your calendar, it's going to be hard for you to actually create the life that you want.
Yep. All right. Well, let's transition now into what we talked about. How many businesses are actually or realistically going to sell? It's very few, 0.02% or so based off some of this data here. If you are fortunate to have a liquidity event, there's emotional and financial things you need to deal with as part of that transaction. We broke some of that down. Now let's go into, okay, preparing my business for a sale. What are some things that actually move the needle? So we've got some data here from Harvard Law School and some McKinsey M&A report, and then also a Capstone Partners Capital Market report. And really what this is showing is that overall, M&A deals are up about 25% since 2024 in terms of the volume. So volume is coming back as interest rates are kind of plateaued or even decreasing a little bit. But on the flip side of that, valuations, or I should say as part of that, valuations are holding strong with a median valuation of 9 to 9.5 times, down a little bit from 2021 highs, but still strong. And then another data point, though, is that private equity, and we've talked about this in past episodes, the whole time up to 8.5 years versus 4.1 years in 2007, meaning that there's a bunch of quote unquote inventory that private equity is sitting on waiting to sell in terms of having second bites of the apple. So lots of dry powder there. So all that being said, though, we did want to pull out what are 6 different things that will help increase the value for your business. So I'm going to go through these real quick, and then I'm going to want your thoughts, Jim. The first one is pivoting from project-based to recurring-based revenue. So that's going to be one thing. Asset-light operations as opposed to large CapEx-driven businesses. Higher margin structure, so gross margins in particular above 50%. Diversified customer basis, so having no concentrated customer that's greater than 10% of your revenue base. Management and team depth, so making sure that a great way is, could you take a 3-month sabbatical and would the business keep running without you? That'll really quickly tell you if you've got management depth. And then growth trajectory. We're going to measure that as 15% plus year over year top line revenue growth. And then those are the 6 things. There's one other thing that I think is important too, but it's kind of like they call it the rule of 40, which is if your profit margin plus your growth rate, those two added up equals 40% or above, that's a rough rule of thumb that it's a healthy business. So that's another kind of variable in there. Again, not so much related to M&A, but just overall rules of thumb. So as you're seeing this list of 6 different attributes of high value businesses, what are a few different things that stick out to you as you talk to entrepreneurs?
Yeah, I mean, these are the big ones, and I'm glad you laid it out like this. And even we're seeing so many companies trying to get recurring revenue. Like we were talking on the drive over about how a lot of CPA firms are now putting people on a monthly recurring revenue rather than the paying for the return once a year. I think maybe they'll get some pushback, but I think if they're all doing it, that's kind of what you're going to have to do to pay for it. And obviously that's a big deal. The asset light operations, CapEx is a big problem, the high margins. So often entrepreneurs aren't worried about margins, but margins matter. Customer base. I will also add to the diversified customer base, diversified if you have distributors or if you have providers that you're getting product from or anything else. If there's a supply chain somewhere, if your supply chain isn't diversified, that could be a problem, right? If there's one provider of the ingredient that you use in your supplement and something happens with that one provider, you got a problem. Management depth is so important, and too often entrepreneurs hold on too tightly and they don't develop an executive team, and then the business is always going to be about them. And then, of course, the growth trajectory, growing consistently over time. Those are all really good.
I like it. Well, we got the visual up on the screen there, so you guys can check that out in terms of some of the biggest drivers here. And the last thing that we should dive into in terms of how do you actually get your business to sell at a high multiple, I think it'd be good to go through just 5 different founders, same exit, different outcomes. And so really here is that it's not just about the sticker price of a transaction. So hypothetically, if you hear, hey, there was a $30 million liquidity event, well, here's 5 different variables or factors that would greatly impact how much money did that entrepreneur actually walk away from. The first one is equity split. So if this entrepreneur was raising a bunch of money from venture capitalists, maybe they only owned 20% of that business. So owning 20% of a $30 million sale, that means you're getting $6 million pre-tax. A lot different than saying, hey, I'm the CEO and founder of a $30 million business that sold. That sounds great. People think you've got $30 million, but it really depends on the cap table. Second thing is deal structure. So cash versus earnout. We see this all the time, and that maybe the headline purchase price was $30 million, but maybe it was 60% cash up front, 18 million cash and 12 million of rolled equity into the NewCo or an earnout, and maybe that goes to zero, which we see happen a lot more than entrepreneurs would like to think. Tax structurings, we talked about qualified small business stock and C corps, and the difference in how these are structured can make a huge difference on if that was maybe the first half of that $30 million is tax free, and then you're paying 20% on the last 15 million, you walk away with $27 million after tax. A lot different than if that was a hot asset sale and it was mostly taxed as ordinary income. Working capital adjustments, and then also rep and warranty insurance. Those are just other things, minutia, I would say, as part of the deal transaction in terms of how much money is tied up in the transaction. Because sometimes, it's a $30 million transaction, but you had to write a check for $5 million to leave ample working capital on the balance sheet in terms of accounts receivables, et cetera. So not all $30 million headline transaction prices are made equal, is the point.
Yeah, for sure. And I was thinking of a couple entrepreneurs that I know of, and they sold their company for $100 million, and everyone assumed they both got $50 million. And the truth was that they had taken on investors, and they owned about half. That's $25 million each. But with the purchase, they were required to roll $10 million each. So they each got $15 million after tax. They each got $9 million. So people are thinking these guys have $50 million each, and they really have like $8 or $9 million each. And then the money they rolled in, the earnout didn't work out, so they didn't get any of that money. And you're not flying around on private jets if you have $8 million. And so sometimes you see business partners like that trying to live a lifestyle to live up to a $100 million exit, when really they need to be looking about how they're going to make money in the future, unless you can live off of $8 million, which, hey, a lot of people can live off of $8 million. But they're always thought of as the guys that sold their business for $100 million. And that's what gets put out there. But of course, did you take investors? What's your after-tax net in your pocket? Did you roll some forward that could, go to zero if the earnout doesn't work out? Those are questions that people don't ask, but that you as an entrepreneur need to ask as you're building out your wealth plan and as you're thinking about your exit. Because a $100 million exit in 10 years might not be what you think it's going to mean if you do any of those other things.
Yep. All right. Well, let's put this all together here from the fractional family office floor. And we talk a lot about what our clients should do, but let's talk about, do we eat our own cooking, and what did we actually do and why? And I know we've jumped into this a little bit, but let's deep dive into our ESOP transaction in 2022 and why we made this decision. So I think the place to frame this up, whenever any client or anybody is evaluating an ESOP, is, well, what are the options available on the table? And so the ESOP is an option, but so is a strategic sale. So this could be a sale to generally someone who's within your industry. That's generally going to get you the most value there. Then there's going to be private equity sale, so kind of more of a financial buyer. There could potentially be a management buyout or an internal succession plan. And then the ESOP would be a fourth option. So those were 4 different options that I know we all kind of discussed, and then we landed on the ESOP. And I'll give you my opinion on why the ESOP won from our perspective, but I'd love for you to kind of comment, just because I think that criteria will help other entrepreneurs who are considering private equity versus ESOP.
Okay. So, well, I'll see if you give the right answer.
So I think the first thing here is alignment with values. I think that was very important, and that this did not result in the optimal financial transaction for you or me, right, or Mimi, but it was aligned with what we wanted to achieve longer term, which was creating a vehicle that can hopefully, and that has proven to create substantial wealth for all of our employees, meaning that not only do we think that we should be getting wealthy as we create value for our entrepreneurs, but our employees who help build this should be along for the ride. So I think it was very, very aligned with our values. I think another thing is that it was aligned with the timelines that we had put in place, given where you and Mimi as the original founders, and for me as a minority partner in the deal ahead of time, it aligned with our timeline of within the ESOP. You don't get all your money up front. You've got to essentially earn all of that money, and the ESOP will pay you off over time. And we had a long enough runway where it made sense for us to kind of to get into that relationship instead of needing an immediate liquidity event because people are burnt out or there's a health issue or something happened. I think the last thing, which I think is a variable, but it did allow us to de-risk a little bit. And I'd say the de-risking to me really mostly comes from the tax arbitrage of instead of paying ordinary income taxes on profit distributions, we now pay the lower capital gain tax rate on our essentially the note pay down from the ESOP. And through smart tax planning, we're both able to really greatly mitigate the tax impact. So I do think there is like a tax or taking chips off the table, but it's not a huge piece of it because we're actually sacrificing an immense amount of upside by going through that transaction.
I agree with what you just said. I'd sum it up this way from Mimi and my perspective would be, number one, we care about our clients and our entrepreneurs, and we feel that our company serves them and provides resources and helps them achieve things and do all the things they want to in their life, including charity and giving back and all those powerful things. And we knew after talking to private equity that they would destroy our model. They would start saying, why aren't you taking commissions? Why aren't you taking all these other ways you can get paid? Why aren't you driving toward raising assets and all the things that we don't do that make us different? They would want to add the revenue that way. And so I felt like this model is something that we want to see for entrepreneurs. We don't have kids. This is kind of our legacy, and private equity is going to destroy that model. So one was that. Second thing for us was staying involved in the business. We sell to private equity. They're going to want control. They're going to probably want me out. And I don't want to get out. I still want to be involved. I still love this business. I love working with amazing people like you and all the people on our team. And then the third thing was, as you already mentioned, like making sure the team is along for the ride. So I want the people who help us grow this thing, I want them to have a piece of ownership in the company, more than just being paid well and getting all the benefits and doing the meaningful work, but also enjoy the stock increase along the way. So those were the main reasons why we wanted to do it. And to your point, we knew that if we wanted the best financial outcome for us, we would have gone a different road. But there were other things that mattered to us as much or more than clearly more than the money, because we didn't take the money. And we could have taken bank financing and gotten a lot more chips off the table. But as you and I discussed, we have confidence in this business. We care about this business. I'm not worried about taking that much off the table immediately. And I don't like bank covenants and to be partnering with a bank in our business.
Yep, makes sense. And I think tying this back into the three different paths we talked about of all in on enterprise value or a lifestyle business, this is a real life example of us taking that middle road of we grew the enterprise value, had a quasi liquidity event, but we're able to de-risk and take some chips off the table in a systematic way over time while still retaining some upside through some upside warrants and stock appreciation rights into the continued growth of the ESOP. So I think this is a perfect example of, we talked about option A, B, or C. This is an example of doing kind of that middle ground of investing for growth and the liquidity event while also taking chips off the table and diversifying.
Yeah, it's been good for us.
All right. Well, that's it for us here today on our podcast. And I think it's important that we always wrap up. What are the biggest takeaways, Jim, as we help our millionaires start thinking like billionaires?
I'm going to say inflation. I think entrepreneurs underestimate inflation and the power and the danger of inflation. And as part of that, think about your cash. Why do you have the cash that you have? And there should be a good answer for that. If there's not a good answer, spend some time figuring out why you have the cash. If you have no cash and there's reasons to have cash, make sure you hold some cash to operate the business, for emergencies, for all those types of things as well.
Yeah, for me, it's the sobering reality on how many businesses actually exit. I think far too many entrepreneurs and business owners assume that there is going to be a pot of gold at the end of the rainbow, and that whenever they throw their hands up, someone's going to want to buy this business and pay a boatload of money for it. And the exact inverse of that is true. And so I think just being very bright-eyed and intentional about what we're doing, and also being very realistic, I think is important, because there's nothing that makes me more nervous than an entrepreneur that has all of their eggs in one basket. And if that deal does not come to fruition, and it does not hit, then everything they've worked for, right, all those years or decades could be completely off the table with nothing to show for it.
You know, it's interesting. I was just thinking about one of the reasons why we could grow when we grew with your help was because Mimi and I never ratcheted our lifestyle up to the amount of money we were making from the business. That gave us float to do other things, to build the business, to take chances, to build a model that wasn't built before. Had we not done that, had we kept ratcheting up our lifestyle, I can tell you we wouldn't have been any happier, and we wouldn't have been able to build what we're so proud of that we built with you and with all the great people on our team.
Yeah, I think it brings up a good point. I was just talking to an entrepreneur about this within the last month of they were upgrading multiple houses, the second house and the primary house. And the math that I was breaking down for them is what percentage of total after-tax income coming in, which is W-2 from the S Corp and then business profit distributions, was going out the door for just your run rate monthly expenditures. And with the new mortgages, plus all of the travel and all of the living expenses, it was going to be about 85 to 90%. So about 85 to 90% of the after-tax cash flow was going to go just to living expenses, which means that you can, by definition, only stomach a 15% drop in profits before you're underwater, and you're then living off of assets you've accumulated, or you need to dispose of maybe these fixed assets that are increasing your quality of life. So there's a lot of risk there. And then I think it begs the question then, but what percentage do you think of your total active income is appropriate to live off of for a business owner? Because that was like an interesting thought exercise for me, that as a business owner, then what percentage of W-2 plus profit distributions do I think is reasonable to have enough buffer to be harvesting, personally and building the balance sheet?
Yeah, that's a tough question. I'm going to switch that around. I'll answer that in a second, maybe. But first, I want to say that it usually doesn't happen like that. Usually there's this progression of you're making no money and then you start making money. And one thing I used to tell young people when I get asked to come speak to young people is I would say, as you make more money in your career or in your business, when you make more money, spend half, save half. Because if you spend half, save half, you're going to be saving more and more every year, but you're still going to be enjoying a better lifestyle as you go. But pretty soon you're going to be saving a ton of money. Because in the beginning, when I was making $20,000, believe me, I wasn't saving very much money. There wasn't much money to be saved. But then when I made $25,000, now I can spend an extra $200 a month, but I can save an extra $200 a month. That's not a bad formula for the entrepreneur to gradually be saving and making more money. The mistake I think entrepreneurs make is they make more money and they just spend without being conscious and intentional, and without even thinking about, is this going to increase the quality of my life? Or is this just some cool thing that I can show off to my friends?
Yeah.
So how did you answer the other question, though, that what you think is a percentage that you should be
Well,
spending?
I think it's very subjective, and I think it depends on like the business, the length of the business. Is it just like a fad business? Because sometimes, some business owners just catch fire, the algorithms hit the right way. So I think there's a lot of different variables, right? But I think to me, and I maybe am a little bit more conservative, I ended up at about 50%. I think 50%, because I think that then means to me you can absorb roughly a 50% decrease in profits and still float your lifestyle. So that also means then that you're saving or compounding about 50%, and which will help build up your balance sheet relatively quickly.
Yeah, I like that number.
Yeah.
And by the way, there's no reason why you can't save 80% of it. I mean, it depends on where you are. And then the problem is once you start enjoying certain things, you feel you have to have them, and then you don't want to step back from them. And then all of a sudden you paint yourself in a corner where you've got this big nut for your expenses every month, and that doesn't allow you to pivot and try different things. And it also is always going to be a stress in the back of your mind, like, if something goes wrong with the business, what am I going to do?
Yeah, the endowment effect, right? That what you have is worth way more than the opportunity cost. Best example is flying first class. The first time you fly first class, you're like, I can't go back to that. Same thing. Then what's the next step? You fly private. Once you fly private, oh gosh, I can't go back to first class. I got to do private. So yeah, once you start, it's hard to stop.
Yeah, I mean, we've flown private with friends, and it's unbelievable. And I always check myself and just go, that is not something that I need. That is something that's important. And first class is amazing. And, one of the things that it's important for entrepreneurs to do is to actually appreciate things, to be grateful for things. And I flew for so many years in coach, and to fly first class, I try to really take a moment and just enjoy, like, wow, this is, because it's easy to just bag on how bad the airlines are and the food and everything else. And first class isn't what it used to be. But hey, flying first class is a pretty cool thing to be in the tip of the plane.
Yep, I can't agree more. Thanks for listening to the Make Rich Real podcast, where $1 million businesses meet billionaire strategies. Please note the following disclosure. This podcast is provided by Do Wealth Management, an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or training. The information presented in this podcast is for educational and informational purposes only and should not be construed as personalized investment advice, tax advice, or legal advice, or a recommendation to buy or sell any security. Nothing discussed in this podcast constitutes a solicitation or offer to provide investment advisory services to any person in any jurisdiction where such solicitation or offer would be unlawful under the securities law of such jurisdiction. All information presented is believed to be reliable but is not guaranteed for accuracy or completeness. All investing involves risk, including the potential loss of principal. Past performance, if mentioned, is not indicative of future results, and no investment strategy can guarantee profit or loss. Any mention of specific securities, investment strategies, or market performance is for illustrative purposes only and should not be considered a recommendation. Economic and market conditions are subject to change, and any opinions expressed are currently only as of the date of this recording. Before making any investment decisions, please consult with a qualified financial professional who can assess your individual circumstances, risk tolerance, and investment objectives. For more information about our services and fees, please refer to our ADV Part 2A, which is available on our website, dowealth.com, or upon request.